let's dive right into this. Welcome back to another Iron Financial Explainer. Our mission here is simple. We want to help you cut through all the market weakness and forge a significantly stronger portfolio. And right now, the global supply chain is basically a battlefield. You've got geopolitical conflicts everywhere, creating this absolute macro volatility meat grinder. And frankly, unprepared investors are just bleeding out there. So today, we're taking a really hard look at the Q1 2026 earnings from Global Ship Lease, or GSL for short, to see if they actually offer a structural safe haven in the middle of all this chaos.
Exactly. And that's exactly why we're tearing into these numbers today. When you're navigating waters this incredibly rough, you absolutely cannot rely on hype or momentum. You need structural integrity. So the question is, are we actually built to survive a supply chain war here, or are we just hoping the storm magically passes?
I mean, let's just be totally real for a second. Maritime shipping is absolutely notorious for its brutal cyclicality. We all know the drill. Rates skyrocket to the moon, and then they completely crash. So as an investor looking at this, can any portfolio realistically withstand the current geopolitical chaos we're seeing? How do we actually forge a portfolio made of solid steel amidst all this macro volatility? Is this company a legitimate built-to-last fortress, or are they just a temporary beneficiary of a highly dysfunctional market? You know, that is literally the exact right question to ask. And to understand if GSL is actually built of steel, you have to look at their absolute foundation. Here's the key difference. They aren't out there playing the spot market casino. They are a lessor. They own the physical ships, and then they lease them out on multi-year fixed-rate contracts to massive container liner companies. It's a totally different business model. And this brilliantly illustrates the exact machinery we're talking about here. We aren't talking about inflexible, massive behemoths that can only dock at 3 ports in the world. Global Ship Lease focuses specifically on mid-sized container ships. They provide the highly adaptable, heavy lifting capacity that the global market so desperately needs right now. When global trade routes start to fragment and break apart, those liner companies need these very specific, flexible vessels to just keep global trade moving.
Market skeptic. Okay, so they supply the actual steel holes to the companies that are out there navigating the chaos. Fair enough. But let's get into the financial armor. I need to know, is all this heavy lifting actually translating into durable hard revenue?
Let's drill down right into the numbers. Q1 2026 operating revenue just hit $198.1 million. That is a 3.7% year-over-year top-line growth. Now, you might be thinking 3.7%, so what? But in a market that is actively facing severe margin compression across the board, consistently growing the top line is the first absolute heaviest block in GSL's fortress balance sheet. It definitively proves that their core leasing machinery is generating massive, reliable cash flow, completely regardless of whatever noise is happening in the daily spot market.
Yeah, but revenue is vanity and cash flow is sanity, right? If their operating costs are blowing out because of inflation or maintenance, that top-line number doesn't mean much of anything. You've got to show me what's actually converting into hard cash.
Fair point. So let's look at that. Adjusted EBITDA for Q1 2026 came in at a truly massive $133.2 million. That is an incredibly high baseline cash conversion rate. The revenue isn't just evaporating into thin air or getting eaten alive by operating expenses. It's flowing directly into the company's war chest.
Okay, that's a big number. But the real question is this cash conversion actually sustainable? Or are we just looking at a lingering hangover from the pandemic-era supply chain crunch? Because we have all seen shipping companies post absolute record EBITDA numbers before, only to watch them completely evaporate a year later. I really need to know if this is a durable long-term run rate.
Then let's unpack the bottom line, because this is where a lot of casual observers get tripped up. Q1 2026 earnings per share was $2.54, which, yes, is a drop from the $3.40 they posted in Q1 of 2025. But if you stop your analysis right there, you completely miss the underlying reality. That Q1 2025 number actually included a massive $28.5 million one-time gain from vessel sales.
Ah, okay. So that previous year's earnings were artificially inflated by them just selling off assets.
Exactly. You hit the nail on the head. So if you strip away all that noise and you just look at the normalized EPS, it sits extremely strong at $2.56. That represents a normalized net income of $92.1 million, and that is what proves their underlying day-to-day operational strength is durable. The core engine of this company is just steadily pumping out highly profitable cash flow. All right, but I look at this fleet composition, and I see a TEU weighted average age of 18.2 years. I have to ask, is this hype or is it real? Because an aging fleet requires expensive, heavy maintenance. Ships don't last forever. How on earth is a nearly 2-decade-old fleet considered solid armor?
You have to look closely at the structural makeup of their 71-vessel fleet. Out of those 71 ships, 41 are wide-beam post-Panamax vessels. Now, this is the exact specific flexible tonnage that today's highly fragmented supply chain absolutely demands. These ships can carry massive amounts of cargo, but they can still access a much wider range of ports than those giant megaships can. So yes, you're right, they have some age on them, but these specific classes of ships are the true ocean workhorses. In a disrupted, chaotic world, pure utility easily trumps youth.
And this brings us to the most crucial point. By the end of Q1 2026, Global Ship Lease was sitting on a contracted revenue backlog of $2.1 billion. Seriously, let that number just sink in for a second. $2.1 billion. And they didn't just sit on their hands. They went out and added $86.1 million in brand new fixtures just this quarter. This creates a massive multi-year defensive shield completely forged around their forward cash flows.
I have to admit, that is a truly formidable shock absorber. Even if the entire spot market collapses tomorrow morning, they literally have $2.1 billion already signed on the dotted line. But a backlog is only as good as its expiration dates. Let's see the actual timeline of these contracts.
And here we go. This is exactly where I see the cracks in the armor. You have 100% charter coverage for 2026. Fantastic. Sleep well at night. But look at 2027. That coverage drops down to 86%. So what exactly happens when these highly lucrative contracts expire in a market that is potentially softened up? That 14% uncontracted exposure could start seriously bleeding their yield if rates decide to plummet.
It's absolutely a vital metric to watch, no doubt. But you really need to put that 86% coverage into perspective. Having 86% of your total revenue already locked in a full year out is incredibly defensive. Pure spot market operators would literally kill for that kind of forward visibility. And to really address that risk, you need to look at exactly how GSL actively manages their forward book.
Their TEU weighted average remaining contract cover sits at a very solid 2.6 years. And they don't just wait around. They proactively extend these contracts long before they ever get close to expiration. Take the Zim Norfolk and the Zim Seaman, for example. These ships were forward extended for 60 to 63 months. Those extensions alone are going to generate $13.5 million in annualized EBITDA each. And get this, they don't even commence until mid-2027. This kind of forward visibility is solid steel, forged through incredibly proactive management.
Okay, so they're securing 5-year extensions well in advance, which definitely patches up those 2027 cracks I was worried about. And honestly, it shows that the liner companies are actively willing to commit their capital long-term because they fundamentally need to lock down these specific assets.
Precisely. And this extreme cash flow visibility is exactly what allows them to aggressively fortify their balance sheet. Their outstanding net debt has decreased to $657.8 million. Now, when you pair that falling debt load with their massive $655 million in cash reserves, you essentially have a bulletproof capital framework. They have built the war chest required to weather virtually any storm while still returning heavy capital to their shareholders.
Right, because debt reduction permanently lowers your break-even costs. So they have a massive backlog, falling debt, and a pile of cash. But what does the retail investor actually get to hold in their hands at the end of the day?
They get a heavy lifting yield. Right now, Global Ship Lease pays out an annualized dividend of $2.50 per Class A common share. And they also maintain a 0.546875 quarterly dividend for their Series B preferred shares. So management is aggressively returning capital to shareholders while simultaneously paying down their debt.
Market skeptic, listen, a high yield in the shipping sector always sets off major alarm bells for me. I have to ask, is this dividend just a massive value trap waiting to spring? If that 27 coverage cliff hits them harder than expected, can they actually maintain a $2.50 payout, or are investors going to get totally crushed?
Well, let's move to the fleet and see how this builds into their long-term survival strategy, because this directly protects that dividend you're worried about. They aren't just stubbornly sitting on an aging fleet. GSL is actively executing a highly disciplined, opportunistic asset monetization strategy. Continuously selling the old and buying the new is essential, mandatory maintenance for a heavy lifting portfolio like this.
So they are out there actively pruning the deadweight. I like the sound of that. But show me the receipts. What exactly are they cycling out of the portfolio, and what are they upgrading to?
Let's look at the actual transactions. They arranged forward sales for 3 of their older non-core ships, the Manette, the Kumasi, and the ENH. They sold these 3 vessels for a total of $52 million, locking in a very nice anticipated gain of $25 million. And then they immediately turned around and deployed $90 million to acquire 3 8,586 TEU eco-upgraded vessels, the Lotus A, the Koi, and the Cypress.
Okay, so they're selling off 20-year-old ships at a premium and then buying larger, highly fuel-efficient eco vessels that already have attached charters stretching all the way into 2030. I have to admit, that is actively upgrading the armor. It heavily increases their operational efficiency and makes them far more attractive to charterers who are facing stricter and stricter global emissions regulations.
But let's shift gears here for a minute. The financials, the fleet upgrades, it all looks absolutely fantastic on paper. But it is time to stress test this hull against the brutal, real-world macro environment. The entire maritime industry is currently sailing straight through some intense geopolitical crossfires. Let's look at the real threats out there. Market Skeptic, the threat matrix right now is frankly severe. We have ongoing Houthi attacks, fundamentally shutting down normal Red Sea transit. We have major disruptions in the Strait of Hormuz, which has resulted in roughly 20,000 seafarers literally being trapped. And on top of those kinetic physical threats, you have a barrage of tariffs, trade barriers, and totally unpredictable suspended port fee regimes. Honestly, can any balance sheet truly survive this level of completely fragmented global trade and forced vessel rerouting? I mean, even their own executive chairman, George Yaroukost, stated that this quarter marks an escalation of the geopolitical uncertainty. The leadership themselves acknowledges that the chaos is actively getting worse. Now, what's really interesting about this quote is how you interpret that chaos. Yaroukost isn't issuing a warning of an impending collapse. He is actually explaining the core catalyst for their ongoing strength. Think about it. When the Red Sea is closed, all those ships have to sail around the Cape of Good Hope. That is a massive detour that absolutely soaks up available vessel supply. This exact disruption supercharges ton-mile demand and heavily boosts the need for GSL-specific, flexible ships. For GSL, the chaos is literally their moat. And to heavily insulate themselves from any sudden violent market shocks, they maintain an incredible amount of strategic optionality. Out of their 71 ships, 23 of them are completely unencumbered. Think about that. Nearly a third of their entire fleet is 100% free of debt obligations. So, if the credit market freezes up tomorrow, they have 23 debt-free ships sitting there that they can leverage, sell, or just continue to operate with absolutely zero debt service burden dragging them down.
Market Skeptic, that is a massive, massive buffer. Having a third of the fleet unencumbered is basically like having a secondary hidden fortress built right inside the main walls. But let's go back to my biggest concern, because I'm still not entirely sold.
I need absolute clarity on the worst-case scenario. The spot market is going to eventually turn, it always does. These current supply chain disruptions might actually normalize one day. When all that excess vessel supply finally floods back into the market and shipping rates plummet to the ocean floor, what happens to GSL? I want you to prove to me that this company won't bleed out and slash that $2.50 dividend the very second the macro winds change. All right, here is the absolute knockout punch. Global Ship Lease's average break-even rate is just $9,807 per vessel per day. That single number covers everything: operating expenses, administrative costs, and all their debt service. As long as they can lease a ship for even $1 more than $9,800 a day, they are generating positive cash flow.
Wow. Okay. Because current market rates are drastically higher than that. Rates would have to experience a total historic collapse to actually breach that $9,800 floor. So their foundation truly is built on rock-bottom operating costs. And in this industry, that is the ultimate undisputed defense against a severe cyclical downturn.
Exactly. The internal mechanics of the GSL machinery are just incredibly well-oiled. They factor in highly conservative estimates, like a 1.3% unplanned off-hire adjustment, which ensures that their projections are grounded in actual reality, not fantasy. And they are successfully locking in forward-fixed direct continuations at highly profitable rates. For instance, the GSL Ningbo was forward-fixed for another 36 to 38 months at an annualized EBITDA of $16.5 million. The gears of this machine are turning flawlessly.
All right, we've stress-tested the hull, we've audited the multi-billion-dollar backlog, the fleet renewal program, and those sub-10K break-even rates. It's time to bring all of this together for the Iron Financial audience.
It's time for the verdict. We've meticulously torn down the Q1 2026 financials, we've analyzed the severe macro threats, and we've heavily scrutinized the safety of that dividend. Now we deliver a definitive, no-nonsense ruling. Is Global Ship Lease a heavily fortified opportunity to help you forge a stronger portfolio, or is it just a cyclical value trap perfectly disguised by temporary global chaos? Here is the official Iron Financial verdict. Global Ship Lease is a structurally sound, heavy-lifting yield play. With a $2.1 billion contracted backlog, a sub-$10,000 daily break-even rate, and massive growing cash reserves, they are deeply insulated from immediate market shocks. We believe the $2.50 dividend is well covered and backed by solid steel.
I actually agree with you. The armor is undoubtedly solid today. However, as an investor, you must stay vigilant. The primary risk remains those 2027 contract cliffs, where the coverage drops down to 86%. You have to watch very closely how management executes the rechartering of those specific vessels. But all of this really leaves us with one incredibly provocative final thought. With the global supply chain actively fragmenting before our eyes, will global maritime trade routes ever truly normalize again? Or is this highly chaotic, incredibly disrupted environment simply the new permanent reality? Keep forging that steel portfolio, everyone. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.